How's it going, everyone? Welcome back. Or if this is your first time here, my name is Edgar and this channel is about personal finance, real estate investing, stock market investing, and personal development. So if that is something you want to learn about, make sure you are subscribed. Today we're going to be discussing how you can buy these so-called stocks that everyone keeps saying you should invest in. Investing in the stock market should be a priority for everyone, whether you invest in individual stocks or index funds. But if you are someone who is just starting off, then all the information out there can be very confusing. So today I'm going to walk you through the basics you will need to know and understand to begin investing in stocks. The first thing you will need to do is sign up with an online brokerage. Now most banks have their own brokerage, but they normally have more fees associated with them, whereas online you can easily find brokerages that offer free trades. Now I want to clarify what I mean by brokerage, and that's just a company that provides you with the platform you need to trade. There are many brokerages that you can choose from, but some of the more popular right now are M1 Finance, Webull, and Robinhood. Now depending on what type of trading you want to do, you might have to do some research to find the best fit, and some of the markets that you can get involved with and begin trading are stocks, bonds, options, currencies, commodities, futures, or cryptocurrencies. Maybe you are thinking of doing a mix of these, and that's fine, but you still need to decide what you want to trade and select the broker based on that. To keep this video simple and straightforward, I will focus on investing in stocks, so any of the brokers I mentioned earlier will work. Now let's talk about the most common types of traders out there, and these can generally be grouped into two categories, which are active traders and long-term investors. Active traders include day traders and swing traders, and long-term investors are people who hold onto a stock for long periods of time, normally more than a year. Swing trading is a style of trading that tries to capture a profit in the stock over a few days or a few weeks. This involves holding onto a stock with the intention of making profit when the stock changes price. This is typically done by buying a stock at a certain price, then selling it once it goes up in price. However, you can also profit by short selling, which is making money when the stock goes down in price. Now, some of the benefits of swing trading are that it requires less time than day trading, and you can maximize short-term profit if you trade the correct stocks, which can then be used to invest in more stocks. Some of the downsides of swing trading are that traders often miss long-term market increases, and a stock can move in the opposite direction than when you expected and can create major losses. Now, you can use something called a stop loss order to limit how much you lose, but more on that later. Day traders buy and sell a stock within the same day, and they sell off their stocks before the market closes to avoid price changes overnight or over the weekends. Day trading requires a lot of knowledge of the markets and understanding how prices change and what makes them change. One of the benefits to day trading is that you can make large profits if your timing is correct. However, one of the cons is that if your timing is off, you can have major losses, and because many day traders borrow money to make these trades, they can be forced to lock in huge losses. Also, to be successful day trading, you must have large amounts of cash available. I mean, think about it, if you're day trading with $1,000, you might only be making a few dollars a day, and when you consider fees, then you will not be making enough to justify the risk. So to have a shot at making some real money with day trading, you must have at least tens of thousands of dollars, which many new investors don't have. Now I want to share some statistics on active trading. There was a study done where they analyzed various trades to see which were profitable, and they found that only 40% of people who begin day trading only trade for 1 month. Then 80% quit within the first 2 years. Then after 5 years, only 7% remain, and only 1% of active traders make any money after you consider fees. Now this isn't meant to discourage you from becoming an active trader if that's where your interest is, but I just want you to have realistic expectations going into it. So with that being said, we can move on to long-term investing, which is basically holding onto a stock for long periods of time, typically for more than a year and very often for many years. This is the investing strategy that I use, and I prefer this because I can trade only when I see a good buying opportunity, whether that is once every few weeks or even every few months. There's even been times when I've gone several months without making any trades because there wasn't anything I thought was a good buy and I didn't think it was the right time to sell the stocks I already owned. Also, by investing in this way, I can still focus on my job as a realtor during the day without having to be glued to my computer checking the price constantly to spot the right time to buy or sell. But the biggest advantage of long-term investing is that you're guaranteed to capture the best trading days, which means you will have a much higher return than those who miss these top days. If we take a look at this graph, you can see that the people who stayed invested over time captured the highest return by far. Now look at your returns if you miss the 10 best days. If you're always trading stocks, the chances that you miss these top days are very high. Now if you were Goldman Sachs and you had millions of dollars invested in computers, then you might be able to capture the best days of one stock, then move on to another stock, but the everyday person will not be able to do this. Now let's take a look at what happens if you miss the best 20 days, then the best 30 days, and finally the best 40 days. So as you can see, the more of these top days that you miss, the lower your returns will be. So the best way to make sure you capture those gains is to remain invested over time. However, one of the cons of long-term investing is that if you put a large amount of your money into the wrong stock, You can end up losing money or missing out on bigger gains because the stock you invested in has remained flat and not gone up with the rest of the market. But you can avoid this by spreading your money over various stocks and doing proper research. Now, when it comes to researching stocks, there are two ways that are most frequently used, and they are fundamental analysis and technical analysis. Fundamental analysis is when you analyze a company based on the economy, its industry, and the company itself. There are many places where you can get information from, but the best information sources will be from the income statement, balance sheet, and cash flow statements, which are reports of how the business is doing, and they are available publicly and free. You can find these on a company's homepage under the Investors tab or on the SEC website. Now, if you're just getting started, you will need to invest time so you can understand what all the numbers mean and how they can be useful to you. The other form of analyzing stocks is using technical analysis. This is simply looking at charts of the stock and trying to predict how it will change based on that. For example, if there's a stock that goes up, then comes down, then goes up again, then down again, then you might buy next time it is down and hope that the pattern continues and it goes up. After you have done your research and you feel you are ready to begin investing, there will be a few different ways you can actually buy stock. Let's say you want to buy stock in company XYZ and the shares are selling for $25. The first way you can buy stock is called a market order, and this means you want your order to be filled immediately at whatever the current market price is. You will use a market order when your priority is buying or selling the stock and not so much the price at which you are doing so. For example, you might see that XYZ is trading at $25 and you feel that's a good buy. Well, if you use a market order, then it doesn't matter if the price goes up to $25.50 the second before you click buy. You will be buying that stock at $25.50. And a good way to remember this is that with a market order, you are buying the stock at whatever the market price is. Next, we have what is known as a limit order, and this is like saying I want the stock, but I only want it at a certain price. So let's say XYZ is currently at $25.90 a share, but you really want to pay less than $25, so you place a limit order at $24.95. What this means is that your broker will not buy those shares unless they reach a price of $24.95 or less, and if they buy it for less, then you got the shares cheaper than you wanted, which is a good thing for you. So with a limit order, just remember you're buying the stock, but you're limiting how much you pay for them. Next, we have a stop loss order, which is only relevant if you already own stock. This type of order can be broken up into two categories, and the first one is a market stop order, and the second is a limit stop order. Let's say you own stock in company XYZ and the stock is worth $25 a share, but you don't want to risk losing money, so you decide that if it goes down to $23 a share, you're going to sell. So in this case, what you can do is place a market stop order, and what this means is that if the stock drops to $23 a share, it will get sold. But because it's a market order, this means that if the stock drops even more, say $22 a share, then it still gets sold. This is because you are using a market order, which means your priority is to sell the stock and not so much the price at which you sell. Now, the other option you have if you want to limit your downside on a stock is using a limit stop order. So if you own stock in company XYZ and the stock is worth $25 a share, but you don't want to risk losing money, so you decide that if the stock goes down to $23, you want to sell. So in this case, you can place a limit stop order with your broker at $23. And what this will do is if the stock goes down to $23, it will let your broker know to sell that stock. But because it's a limit order, your broker will only sell at the price you set, which in this case was $23. So they will not sell at $23.01 because at this point it still hasn't dropped low enough to trigger the sell. And they will also not sell at $22.99 because that is below the amount you said you would sell at. Now let's say that bad news came out and it goes from $25 to $23.10. Well, at this point, because it hasn't dropped to $23, your broker will not sell. But if there's a big sudden drop, say from $23.10 down to $22.50, or your broker still won't sell because you said you only wanted to sell at $23. Now what if it keeps dropping from $22.50 to $22, then to $21? Well, you're going to be losing a lot more than if you used a market order. Now I'm not saying you should never use a stop limit order, but you should be aware of how it works so you don't make a mistake that costs you big. Now there's obviously much more to investing than what I just mentioned, but as someone who is just starting off, you should really become familiar with the basics and then progress to more advanced trading and researching. Now here are some tips that can be helpful when you're just starting off. Tip number 1 is to consider investing in businesses that you are familiar with, and this can be because you have used the products that business makes. For example, if you are a big consumer of Apple, then you are familiar with their products and what works and what doesn't, and if their phones and computers are better than others on the market, then Apple stock could be a great buy. Then you will also know how their customer service is, and a company who values their customers will be in a much better position to succeed and do well, and this means that your investment will also do well. Now tip number 2 is to consider investing in the company you work for. For example, let's say you work at Cintas in their logistics department. Well, this means you are familiar with the company culture and how it operates behind closed doors. If you have upper management telling you to cut corners in order to save money, well, that can be a sign of problems and you probably don't want to invest there. But if management is always stressing quality and putting the customer first, then that's a good sign. Basically, if everything you find out is good news, then investing in the company you work for can be a great investment, not to mention that many companies offer stock benefits for their employees. By investing in companies you are familiar with and have knowledge about when you're just starting off, it can give you an edge and a confidence boost to continue investing successfully. And having your first investment do well and provide you good returns can be the difference between someone who continues to invest and someone who gives up on investing. So with that being said, these are some things that should help you out if you're someone who is new to investing. And if you found this information helpful or you enjoyed this video, it would really help me out if you hit the like button and subscribe. Thanks for watching, and I will see you next time.